Good morning to you. So house prices are still falling, but they're not falling as quickly this month as they were a month ago. The Nationwide just told us that house prices fell by roughly 1% in the month of June. Let me put it another way. Compared with a year ago, the value of the typical home has lost some £11,500. Well, let's get some thoughts on this from Jonathan Davis. Now, he speaks for a website called housepricecrash.co.uk. He also works for a company called Armstrong Davis Financial Planners. Melanie Bien, you'll know, of course, from Savills Private Finance. Good morning to both of you. Jonathan, just your thoughts on this, first of all. If they're not falling as quickly as they were a month ago, that's good news, isn't it?
It's good news for some. I think, however, the figures do mask the reality that since September, prices are probably down about 15, maybe even 20% in many parts of the country. And there's a lot more of this to come.
You say down 15%, but the Nationwide has a slightly different figure for that. It says, I don't want to get into a spitful fight over numbers, but it says that house prices are down just 7%.
In 12 months, and I'm talking about since the credit crunch really took hold, which is September last year.
Is the market as bad as he says it is?
I'm not quite as gloomy. I mean, obviously, the Nationwide figures are evidence of further slowdown in the market, which, you know, we are seeing. We are in a housing downturn, and prices are falling across the country. But we're thinking that the gradual slowdown will continue rather than actually seeing a price crash.
So you're talking about a gradual slowdown?
Yes.
You're, as the website says, still thinking that prices are going to fall sharply further.
It's inconceivable, actually, that they won't, because it has done in America, in Ireland, in Spain, right across the Western developed world. This has got another 2 or 3 years to go, and we would forecast about another 30% fall still to come.
This is astonishingly gloomy.
It's economic realism.
Really?
Well, as I say, look across the world.
But this is the British housing market we're talking about. If you go on television, you talk about house prices falling as much as that, that's going to frighten a lot of people.
I've been saying the same thing for the last year and a half. I was called a loony then, and I've been absolutely accurate.
I wouldn't be so impolite just to call you that, of course.
Well, a lot of the problems at the moment are down to the problems in getting credit, and we've seen lenders have practically shut up shop. And a lot of forecasts really depend on what's going to happen with that, whether the market eases there and whether lenders do come back in. We've seen a few in the last couple of weeks, like Alliance and Leicester, coming with lower priced products. And there's a feeling that, you know, that they do need to lend, and they will come in and offer good products, and then people will borrow, and then they'll go back out again. That will continue. We're not going to see them all come back in wholesale.
Globally, banks have lost $400 billion, and some estimate it could be up to $1 trillion. When a bank makes $1, they can lend $10. When it loses $1, it restricts its lending by $10. That means that there's less lending in the global economy to the tune of $4 trillion. That's going to mean that this has got 2 or 3 years further to play itself out.
All right. Jonathan, Melanie, thanks both very much for joining us here in the studio.